Okay, thank you very much for the nice introduction, everybody. And it's amazing to follow Bill Duryea. I was a student of Bill's in 09, 08, 09. Bill, if you're still there, thank you for everything that you do over the years. I thought you retired for a while and went up to do this Skeeto project, I believe. And Bill taught me a lot about the auction market value theory. And he was, when I found him, he was all about the Institute of Auction Market Theory, something along those lines. IOAMT, I believe. And it was so little brief history real quick. Yes, I did come from the other side of the business. Both, I guess, starting in 1994 from the venture capital and private equity, and went into investment banking after that. And it was all about deal flow and handholding the executives that you took their companies public and basically trading their illiquid positions and putting collars on and things of that nature. Doing special derivatives for them, and for instance, one of the more famous ones is out there. Mark Cuban did a collar on Yahoo, and where everybody else rode Yahoo to the bottom, he cashed out in what's a collar position using options, and set him for life. So that was my job, is to the corporate executive services desk. Is on the investment banking side, what we would do is we would take these companies public, and then we'd handhold the investors and try to tell them, hey, listen, you need to diversify or protect yourself. So I got my start through there, went through a professional trading program at a company called UBS, Swiss Bank. Happens to be one of the largest trading floors in the world. And that was my real, kind of my real foot in the door for trading. And it was from there that I really started to believe wholeheartedly in strictly order flow. And I went to Bear Stearns, and Bear Stearns was number one and number two in every business they did. I went to them because I would have autonomy. I acquired quite a large book at Swiss Bank, and I sold it to Bear Stearns. And I handled executives and of some of the S&P 500 corporations and some of the largest hedge funds in the world, and I would do the trading for them. So I kind of have an idea. I kind of have an idea of what it is to be on that inside, and what the tricks and traps that we would set. And the only reason why we're setting these tricks and traps is to create liquidity for ourselves. So whether we're spoofing the market, which is sending out orders above the market or below the market, trying to get people to buy or sell. The idea really is to understand what price is, and price simply is about advertising to get you to do something, okay? So that's pretty much what I'm going to talk about today. I'm going to talk about the structure of the markets, and in all of the great presenters leading up to this will really hone in, hopefully, a great understanding, and you would definitely learn something very, very vital here. And you can take any one of the indicators or styles or strategies that you relate to today, and apply that and actually really do well with it. And that is one of the problems that I found when I left. So I went from Bear Stearns, by the way, to a prop firm, a professional proprietary trading firm called SunGuard, one of the largest data providers, HFT traders behind like Bloomberg. And I was able to leave Bear Stearns at the top and basically sell all of my shares and use this opportunity to still trade other people's money, of course, but trade the bank's money and short the entire financial markets, every bank-related, mortgage-related, Fannie Mae, Freddie Mac, you name it, everything, but it was only New York listed stocks that we made markets in. until the SEC said you can no longer borrow those and short them. And that all happened to be about $30 a share. And we know what happened with Bear Stearns. It went to 2. Morgan Stanley went to 6. Citibank went to 2 and 3 and did a reverse 10-for-1 reverse split to get it back up to 30. So there's a lot of things that they can do to manipulate prices, whether it's government or it's a company, doing buybacks or splits and things of that nature. Apple just did a split. In effect, that is actually manipulating price. So we have to understand more than just price. We have to understand what Bill was talking about is the auction market theory. And I think it might have been Bill who introduced me to one of the most amazing pieces on auction market value theory that I can offer out to you all in a bit. But while I'm on this page, I'm part of a trading group. So we're an international trading group called Global Trade Room, and our head trader is a licensed commodities trading advisor, CTA. So he can manage funds. But what he does is he manages his own family of funds, and there's an opportunity to watch him overlooking his trades. And we call out the trades, the exact entries and the exact exits before they're taken. And we show, we'll trade 6 to 10 different markets, and anything from crude to gold to the NASDAQ to the Russell, and you'll also be able to see some of the entries, but they're clearly called out in advance, the entries and the exits and the stops. And what we use is the auctioning process that I'm going to teach this evening. And what I'm going to finish with is after we all come with a great understanding of what the market is actually there to do, then we're going to apply a strategy that I've developed over the years. It's called the core satellite strategy. Okay? And core satellite is going to be your assets, your longer term trading, your swing trading, your multiple days, things of that nature. Your satellite strategy is your income generator. And that is your scalping, your day trading, your trading your highs and your lows and things of that nature. So I'm going to introduce a product that has been around for quite some time in the European markets. European options have no expiration. And they're introducing they started an exchange called the North American Derivatives Exchange. And this is in Chicago, and it's a transparent exchange where it's members only, and anyone can be a member with a minimum deposit of $100. So you can take these strategies that you've heard today, or that I'm going to profess today, and you can trade with the bias of your understanding price in relation to value, or context as it's called. So if you'd like to just take this opportunity, just because I know it's late, and I know this will be recorded, I understand that, but if you click on this, we're doing the first ever 3-day workshop just for you folks, okay? This is free. So you click on this link, and you'll go to this page, and it'll describe each day, day 1, day 2, day 3, and just below, you're going to click, for some reason I have it refreshed, but if you click on this, this should show up different. But I'm going to introduce you to this evening, actually, I'm sorry, this morning for most of you. You're going to start in the London session, okay? The London session is moderated by Sandy Segal, full-time trader, and he also worked with some of the banks, JP Morgan, Citibank, Merrill Lynch, Santander, and his job was risk analysis and reporting. And so he's going to focus on the most important component of trading, which is risk analysis. And I'll also do a little presentation about what it is that gets us into trouble as retail traders. And it's that we're taking on too much risk, and we don't even know what we're really controlling. So we're really going to focus on that this morning, and then we're going to lead on into a live trading session with Simon Joseph. Now he's I nicknamed him the Professor. I found him after being with Bill what I really needed to help my transition, because obviously I thought I knew everything. Trading for the big firms, trading these large positions. I mean, literally these sizes of the trades would take me a couple weeks to get done. They were so large. And I needed to transition from that side and trading other people's money to retail because it just didn't work. There were two different camps. There was so much access and technology that I had, and I just didn't have that on the retail side. But what I did know I needed was I knew I needed to look for order flow and managing time and sales and tape. So tape reading was, what I knew I needed, and it was my search to find the right mentor. I happened to find Simon I appreciated that he was licensed to show his screen. So you'll see that most of the rooms out there, in the space are not able to legally show their screens because they're not licensed to do so. So they can only advise on what they're doing on their account, and they can't show it to the side. So when I actually get to the Nadex platform, I have to do it in a demo account for compliance reasons. So I want to apologize for that right up front. But his background is mathematics and physics, and I've always been interested in mathematics and physics myself. But what it was great is you would show his live account, and he would help you kind of earn while you learn the strategy. So you could literally piggyback on the trades because they're being called out in advance. And so that really helped me in the beginning. And so I've gone on to develop and support him and thank him for his, being able to help me transition from Wall Street to a successful retail trader, and now being able to support him through the education series that we do in the afternoons. So we trade all day, every day. We have an Asian session, a London session, we have the morning New York session, and the morning afternoon session. And it's just 5 days a week, starting Sunday evening. Okay? So a little bit about the group I'm trading with. You can go to the home page, click on the 3-day trial, go ahead and sign up. You'll find some great educational material there if you go under education and live calls, so we keep track of our live calls. You can also, so one of the things that really bothered us about everybody out there in the space is that no one was transparent. And there's a lot of reasons why they're not legally, and maybe they're just, no, it's mainly futures trading. But if we're trading Forex, we're trading the underlying futures contract. Thank you for the question, Bob. Next, Nadex is binary options, and I will get to that. But what's important to understand is the concepts of the market. So what I want you to do is do your own due diligence, taking a look at this screen here. There's tens of hours of videos on how we trade. And I want to set the stage by talking about the auction market theory. Nadex itself is just an exchange. Just like the New York Stock Exchange, just like the NASDAQ, just like the ICE, just like the NYBOT, et cetera, okay? It doesn't really matter if you're trading Forex or futures or stocks. I trade them all, but what is more important to understand is the concepts that I'm going to discuss now, okay? So I'm actually going to do something. I'm going to pull up just a chart, a paint bar. And let me bring this in, okay? And I'm going to, yes, that's okay. I'm going to draw the markets, and what I'm going to do is help you understand the purpose of the markets, and then we're going to be able to take a look at some live markets, and we'll find these levels that we can put on trades for. Now, with binaries, you can put on for every other hour and weekly. And there are great opportunities for this because you can get started with as little as $100. So no matter where you are in your trading career, anybody can do a $100 trade. And it clearly identifies your risk. But if you just placed a random trade anywhere based on price action, the odds are you're just going to fail anyway. So you might as well just save your money and use it towards the education. So let's focus on that right now. I'm going to draw The market's based upon the process of the auction market theory. And what I'm drawing here are obviously different boxes. But what I want to note here is this is on a time, this is the time axis. This is a price axis. And this will be the volume axis. So on this side will be what's called a volume profile. So it's going to show you all activity at each price over time. Okay? And with that definition, we can come away with a few things. This is going to be considered value or perceived value. This is also going to be considered another term, fair market. Or another term is going to be considered balanced market. And this is going to be a price high and a price low of this range. So notice that I'm not being particular about price, about volume, about time, or about the market. As long as it's a market that's traded with a buyer and seller, it is the auction market theory. Okay. Price will, and what will happen is a market's job is simply as an exchange. So the Nadex is an exchange. Its job is to simply bring together buyers and sellers, period. There's no bias whatsoever. There's no manipulation. And, believe it or not, there's 100% transparency in the markets. Now that transparency is shown very clearly at the institutional level. Now if in other words, we are the markets on an institutional level. We have enough volume to control greater than a large percentage of the volume for that day in that security or that market. But the fact is that we're confined by the actual market. So we can't dump everything or buy everything at one price. So it has to be done over time. Is everybody following me? So if you can identify this information and track it, price can go from low to high, low to high, low to high, or high to low, low to high, etc., etc., etc. Okay? And whatever period this is, you can determine something. You can determine the value area high here and the value area low here. And this entire value area is based upon a 17th century mathematical equation, standard deviation. And it will represent 68 to 70% of all trades, all volume that occurred within that time frame. Now, I swear to you, it doesn't matter the time frame. It can be a 4-range chart, a 4-Renko chart. It can be a 5-minute chart. It can be a weekly chart, a monthly chart, a yearly chart. You can determine this information based upon these very basic components of the market. Yes, exactly. Is everybody seeing Bob's note there? Buy at wholesale, sell at retail. So let me talk about the process of getting from one value area to the next. Okay? This is called a balanced market in between here. Also, has everybody heard of the efficient market theory? Remember back in the 80s and 90s, that was a big term. Efficient market theory, and it's correct, but it's only partially correct. We have to put that in context. The market's job is to be efficient, but it can only be efficient over time by bringing together all the buyers and sellers who are willing to do business at a specific price range. And why is it important to also notice these levels and these values? because as an institutional trader, remember, you have large orders every single day, but you're given a range by your client. So let's say I'm doing an Apple buyback of $100 billion. I can't obviously put that in the market. Otherwise, that stock would run to $1,000, right? So it has to be done over time. So every single day, based upon the volume of that day in that average trading range, I can do roughly about 10% of the volume. So I will have to work the majority, the bulk of my business to get paid myself, because I get paid on transactions, is to do my bulk of my trading within value. This is where the bulk of the market will trade, and it will show up on what's called a volume profile on the far. If you put it on the far right hand side, the volume will stick out like this, like a big belly, and that'll indicate lots of volume occurred within this area. And then it drops off, and then it'll restart, and then it gets real small, then it restarts. Okay? So this is a different way to analyze volume than your standard, this is on the bottom here, volume there. So my job is to find trade as much as I can get done within this area, and I can hide within volume. I can hide with volume and not show my hand. And what happens is I have to report back according to what's called a volume-weighted average price. And that VWAP, volume-weighted average price, would be a grade. So I would report back the tranche or the block of trades back to the client, and I would give him a price versus VWAP. So let's consider VWAP as a C grade. And if I can get better than VWAP, then I get an A or B. If I get worse than VWAP, then I get a D or F. And if I get a D or F, I can't do that very often, very many times. Otherwise, Apple will go to the next firm for their buyback. So it is competition every single day. Okay? So getting the most done within this value area, understand that there's going to be the most tricks and traps of the trade are going to be initiated through this value area. In other words, iceberg orders are going to be initiated through this area. HFTs and algorithms are going to be turned on in these areas. And those programs represent about 70% of the daily volume on the New York Stock Exchange. So it's a very, very big component now. And of course, it's the institutions that write those programs. And all it is to help create liquidity so that we can get the larger pieces of the business done. Absolutely, dark pools, and these dark pools, or secondaries, or private negotiated deals. These can be priced when the market's closed, and the bank assumes the risk. And then that order flow goes to the desk, and it's the trader's job to unwind itself or to hedge itself throughout the day. So for that business, I would go to a big company, and I'd say, hello, Mr. CEO, CFO, and the entire suite. I can get you out of a tranche of 10 million shares. You guys can all retire rich. And for that, we're going to take a 50% or 15% cut. And you can receive a check tomorrow, and we will assume all the risk of trading out your 10 million shares when your stock actually only trades 1 million shares a day. So one of the things that can be done is that can be priced in a dark pool or a negotiated trade or a secondary. And you can actually take time, almost 48 hours, to actually report the actual print or the price that's been had. So in other words, price can be manipulated, and it's very important to understand where is price in relation to value. Let me pause for a moment and see if I'm losing everybody. I know it's late, and I'm probably I'm trying not to throw out jargon. I'm trying to keep it as simple as I can. But in the end, what I want you to understand is the markets are going to trade from balance to imbalance. And its job is to find fair markets. And it can auction outside of these areas to find the next area of buyers and sellers. And this area of buyers and sellers, you can go back in time and find a previous level of buyers and sellers. Where at this point in time, the buyers took over. Now there's something that has to happen in order for the market to move outside of an efficient market. It's called an imbalance. So a market will move from balanced to imbalanced. And there's a way to record that imbalance. An imbalance, if you're looking at numbers, are going to look like this. If you're looking at time of sales or a footprint, as Bill's team was showing, you're going to see something like 10 by 50, okay, at that price. Then on the next, you're going to see 150 by 40. Then on the next, you're going to see 120 by 30. Okay? Now, if you look at this 10 by 50, this side being the bid, this side being the ask, if you look at this, can you notice anything here? Just by looking at 10 by 50, 150 by 40, 120 by 30. My guess is not really. I can see it went from 10 to 150 to 120. I can see it went from 30 to 40 to 50. So it did increase on the ask. Is that about right? It increased on the ask 30, 40, 50. Right? So let me ask you a question. If you're looking at 30, 40, 50, are they getting more aggressive? Versus the other side, 10, 150, 120. And the actual answer is no, they're not. Because you're not reading it correctly. You need to read the tape. It's 50 into 150. It's 40 into 120. It's diagonal. The price at which the ask is here, and the bid is here, and the print is here. So you want to look for imbalance. An imbalance is someone with enough capital who can trade 300%, 400%, 500% over the other side. So notice this 50 into 150 is 3 to 1. 40 to 120, 3 to 1. So this is actually, you might look at this going, oh my gosh, it's going up, when in fact the trade imbalance is to the downside. And that's a common mistake most folks have when they're starting to get into reading bid and ask numbers. So in order to come outside of value, you need to have trade imbalance. And you need something to help you track that transition. The only way you can move, the only way if I'm in here in this value area, I can move outside of an efficient market is to create an inefficient market by creating an imbalance. So I would have to be a large seller in here in order to finally move this price outside of this range. And I would get right into the next area, and then it could trade here, 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 here. And if I wanted to continue, I'd have to, again, be a very large seller to create another imbalance to search for the next value area. And guess what? We would have this information on our Bloomberg machines, and we would have the other side, we'd have the trader of that guy at Citibank, Goldman, Morgan, first name basis. Get me Bill. We would have, that's how you make a market. That's all we were there, was to create a market for our clients and to offset and transfer risk. So that is the process of the market. The market is simply to find buyers and sellers, and you can analyze this through trading imbalanced areas. And if the biggest and the baddest and the icebergs and the dark pools and the HFTs and everything else are trading within value, one of the first things that I suggest you do is put a big X through that area. Don't trade it. The odds are you're just going to provide liquidity for the algorithm, and you're just going to end up paying commissions, taking more trades. In other words, you're going to buy a breakout just before it breaks down. You're going to buy a breakdown just before it breaks up, and that occurs within this value area. Are we clear? Any questions about this? Yeah, go to the link here. It says details here. Click on the link. And as you go down, you click on each link and you can register. Yeah. Just sign up for the first day. We'll make sure that you get the remaining sessions. But we're going to start at 4 a.m. this morning. Okay, so is everyone clear about this example that I gave? And I promise you, I promise you guys, I know this looks like chicken scratch, but if you can stop looking for the next best indicator and start to understand what the market actually does and its job, you will stop getting faked out. You'll stop buying tops and sorting bottoms. And I'll tell you why. What I would do in this value area is buy and sell large positions in order to get paid, okay? But if I just report a VWAP, I am at risk of not getting more of that deal. So, in order to better my VWAP, I have to become a speculator. And so that means once I can identify a value area, and I'll show you how to do this on a regular bar chart, so it's not just like this, okay, guys? I promise. But my job is to, as the price moves out of this area, it's to short, not take longs like all of you have been doing, or the majority, 90% of them, 90% of the retail out there, they will buy this as a breakout just before it goes a few ticks and flips back around them. Vice versa, as the market's coming out, I'm looking to buy to better my VWAP. So my question is, my question is to you, if the institutions and the smart money, whatever, I hate that term, by the way, smart money, because they've shown us how dumb they can actually be. I mean, Bear Stearns is not around, Lehman Brothers is not around, that was supposed to be smart money, right? But if those controlling the markets are trading in this manner, why as retail traders, why do we try to do it differently? So that's a question I had to ask myself when I was transitioning over. Because of course I didn't have the right, access and technology, and I had to search for it, and I did my own due diligence. I was pretty good at that. So I found the right guy, and here I am. So let's take a look now at some charts and take this concept even further. Let's see what I have available. Let's just go with a regular bar chart. I don't want to scare you guys with numbers. Okay? But this is considered a bar chart with volume profile. And you'll notice that there will be prices. For instance, here, prices will consolidate on volume, and trades can occur here, outside of volume, low volume. How do you mark a spot? Mark down phases or not? I don't understand that question, Bob. I'm sorry. Go ahead. On the big trends. Well, you have a longer term time frame. That's the only thing I can tell you. Is look at a longer term time frame, and that'll give you the trend. Because the trends are controlled by commercial traders, institutional traders, and the Fed. Big trends. Throughout the day, it's controlled by obviously getting business done, and then the edges are controlled by speculators. And so the problem with retail traders is we all traded in the bulk of the business where we're our max competition. We were trading 1 lots, 2 lots, 3 lots, 5 lots against the guy that's doing 50 lots, 100 lots, and has more behind it. And so that's why we're getting eaten up and just paying commission fees and just being break even at best. So the best thing to do is to know your competition, know where they trade, and then don't trade there, and look for your edge. It's all about having an edge in the markets. So the edge, in my opinion, is going to lay outside of these areas, not within. So I can take this information here, this value here, and transfer it over into the future. So I have value here, 625, 626, and it becomes 78, 79. It becomes information for me to make decisions upon for today or for tomorrow. Now, what I can also do, so let's draw out a few of these, okay? I'm going to draw out the bulk of the value areas. And let me ask you guys, well, I'm not going to. Let me mention one thing. If you can understand this information that I'm teaching you right now, you will not be shorting on a day like today. You will be looking for places to buy. Okay? Now, if I can get you back, I'd have to go back more data to give you. Let me see if I can without messing this up. Well, 9. How many days have we been trading September? I'll try 30 just to see what happens. See if I can get back some of this. Okay, so the question is, do I make my value areas from the immediate day, multiple days, or weeks? Okay, so remember on this drawing, I didn't note an actual time. And what I want to look for is value over time. So when there's something called overlapping value, so this will encompass all of this here and all of this here, and this is within range. So this may be a month, this may be a week, this may be a day, this may be 30 minutes, 15, 5. It doesn't really matter. All I'm looking for is where buyers and sellers got together and did this and did this. So all we want to, because let me show you this real quick, just so you can understand. Let me mark off just this buy level here and this value level, where this is a 30-minute bar on the Russell. See how this value here, the low here, not the price low, but the value low here, and the open here at 1142.2. That's a value area. This is called an unfair low down here. This low is basically flushing traders before it turns. And if you did this exercise where you looked at every single pivot point on your chart on any time frame, you will notice that they use price action and these candle bars to advertise you to do something you shouldn't do. In this case, it's obviously full red bars saying, oh my gosh, I need to be shorting all day long. And just before that pivot, you'll see very, very heavy selling and then buying. Very, very heavy selling and then buying. And on the top side, very, very heavy buying and then very, very heavy buying and then selling. So remember, price is manipulated. So it's better to take price in relation to context of value. And so I can say, if I go back in time, I promise you, this level between 1147.3 and 1142.1, there were buyers and sellers there previously. Let's take a look. Oh boy, looks like I gotta go back even further. Okay, I would have to go back even further, and I don't have the data for that, but you can see that this price here on this 130-minute bar, see how it touched at 1147.6, that spot? Just trust me, there was somewhere in the past that there was buyers and sellers, and the buyers took over from this spot. And that's what created this support line. And you can use that in the future. Just like I'm going to show you how to use right now this same level 1145 and this level ahead 1167. So we're currently at 1157. Let's go into the Nadex. And again, I can't put on a real trade for you for compliance reasons, but I'll show you exactly what you can do. So again, Nadex is an exchange. And you can get a free demo account and it's going to come up with the market. Now these are all derivatives. So these are contracts, just like an option contract. And there's expirations, but they're built upon European options which have no expirations. So there's a binary, so there's no way to take in premium, okay, first off. But what you can do is you can buy these different levels, and each one of these levels will equate to, if I do a, let's just take a look real quick at tomorrow's expirations. We have, everything that's in a binary is worth basically $100. So if you buy something at $50, then your risk is only $50 and your upside is only $50. If you buy something at $20, your upside is $80 and your risk is only $20. Okay? So obviously the idea is to buy low, sell high. And if I take a look right now at 1145, okay, 1145 area and 1169. Let's take a look and see those markets. 1145 is, the closest I have for tomorrow is 1146. So I could go on to this exchange And if I were to believe that this market is going to finish above 1146, 1146 or greater, so this is called Nadex. I'll pop this into the chat box. You can get a free demo account, nadex.com. It only takes $100 to open an account. And you can get a free demo for like 14 days with no money. But to be a member of this exchange, it costs $100. And what I like about that is that there's no HFTs and algorithms in here. There's no institutions. This platform was actually created for retail traders. So we're not stepping into the S&P 500, which is basically the World Series, or it's not the U.S. Open or something like that. And you're not playing against Tiger and Mickelson and everybody else, or your soccer fans or your major football Super Bowls. That's what the S&P is for. The S&P is for the big wigs. So we have to understand our competition, and we have to trade our edge. So our competition is trading in those value areas. Now let's also trade the right market for us. Let's also trade the right leverage for us. Let's not control $64,000 of the S&P E-mini contract with $500. And then go, oh my gosh, it's only $500. I'll just go ahead and I'll buy 4 contracts. Well, 4 contracts at $60,000, you're controlling a whole lot of money. It's just too much risk. Any tick that goes against you, anything that happens, you could be out of business. And you have to respect the market, that if it can take out firms like Bear Stearns and Lehman Brothers and Merrill Lynch, put Goldman Sachs on its knees, it can definitely take out our small accounts, right? So this is going to be almost a sure bet that tomorrow by 4:15, it's going to trade above 1146. So if I have believed that, I would click on the buy side, and I could go with 1 contract or 5 contracts or 10 contracts, but it'll tell me, listen, hi, your max profit is $15. Your max loss is $85. But you have about an 80% probability that you're going to get that $15. And it has to close above 1146 by 4:15. Now this is a beautiful thing to do on Sunday evenings and Mondays, when you can buy for the entire week, called weeklies. Obviously these are expiring tomorrow, but you can buy these weeklies. Let's say 1167 is that next value area up here. Let's say we're going to finish less than 1167. So I go into this 1171 or this 1165, and I can actually say, I disagree that we're going to trade above 1165 or 1171. So I could sell that and sell that. And if I add together my total risk, it still outweighs my reward, my total reward. So I probably don't want to do that either. But I could also go like this. I could say, all right, well, because we have auctioned down, we found buyers at 1144, and we're consolidating here, most likely we're going to come in to about 1153 and then head back up towards 1168. So if I buy, I go out to, say, 1171, and I say, I believe the market's going to close at 1171 or higher by tomorrow. I can therefore buy this at $14 and make 86. So if I wanted to do that in, say, 5 contracts, my max loss is only $70, but my max gain is $430. And I can put on a position for the entire day as the market comes in and consolidates around here and tries to auction back up towards 67. So I'll have all day, so I don't have to, so I can, instead of trading these markets tick for tick, I can trade these value areas. But let's say I also want to protect myself. So I want to take some upside, but I also say, you know what, just in case, let me go ahead and look at buying that we're going to close above here. So I therefore have a high probability, 80% probability, that I'm going to close above 1146 by the rest of the day. And I have a good probability that I'm going to close above 1171. So my max profit on this is 1550. And I could actually subtract that. 7750. I could subtract that from my max loss here, and I can control this risk. I can control these two ranges. Let me do it very simplified for you with one contract. And therefore, I'm no longer trading price. I'm trading value. And I know after that very intensive teaching that I just did, that the market's job is to seek out value. Those are the two value areas. And all it's going to do throughout the day is just advertise price. Now, if you want to go in and put those on, and then you want to do your day trading in between, well, hallelujah, you're covered. So you have your asset class working, your longer term, and you have your income strategy in your scalps, your day trades when you're fading the edges, buying the edges, not shorting, coming down into the lows. So again, just a very easy way to get involved in all markets. You can see that there's a list of different markets here that it covers. You have small cap, S&P 500, DAX, Japan, FTSE, technology, the Dow. You have Forex spreads, commodities. You can do it on crude, silver, nat gas, Forex pairs. And then there's something called bull spreads. Now, bull spreads is basically what I did with those individuals, but putting it into one contract. So if I took tomorrow's spread and I said, okay, I believe that we're going to go between 1145 and 1170. Okay, I see 1140 here and 1170. So what I have here is I would have to buy at this price, 1156. Sorry. And my risk would be 165 versus 135. But what this says is if I'm dead wrong, my floor is at 1140. So in other words, if this market ends up going lower than 1140, protected. The most I can lose is 165. But on the flip side, if this market turns around and goes way above 1170, I can't participate in anything above 170. So the most I can make is 135. So guess what I'm going to do? I'm going to wait to initiate this trade until I come in closer to this level, this 145. If I can get closer into this 145, I'm going to increase my maximum profit and reduce my maximum loss. And my floor will still be 1140. So the closest I can get to 1140, the better. And then it's all upside from there. Very little risk. Let me see if I can, let's see here. We're at 1150, 1150, 85, 1140, 70, 1130, 80. Let's do this one. 1125, 1155. Let's say I disagree. Let's say initially I go, you know what? I'm going to go ahead and I don't agree.
I don't agree that we're going to trade above 1155. So we're at 1155 right, nope, sorry, we're at 1156.8. And so what this means is, if this goes up to 1170 and I'm wrong, all that I lose is $56. But if this comes in to 1145, I could make $244 on one contract. So if you're comfortable, you can do, let's just say let's keep your $100, okay? For maximum $112, I can make $488, because I would bet that this market's going to come in first towards this area before it gets long. So in other words, I can do this throughout the day, and this is liquid. Right now it's 30 by 30. That tells you the size on the bid and the offer and what's traded. And guess what? The spreads are large because there's no market makers. So there's sometimes a 5-point spread in there. So if you want, because you're a member, you can put in your own price. You can make your own market. And if the other side takes your trade, you're filled. And that's the exact same thing that the institutions do. I call up Citibank and I say I've got 360 million grade A paper, mixed paper. And I'm looking for a bid, par +5. And he goes, I'll give you +3. And I go, +4, fill and kill. Done. And that's how it's done. So I guess I should open it up for questions, but we'll continue this whole, watch us trade this entire strategies live. And what you'll take away is that the accuracy is superior. The risk that we take is mitigated. Any market we trade, we're talking about 4 ticks, 5 ticks risk. So if you're trading crude or a Russell, you're talking about $10 per tick. You do one contract, you're talking about $40, $60 risk. And crude and things can run, 30, 40, 50, 100 ticks. Now I'll give you an example. Just today alone, we called out 198 ticks. That's almost $2,000 in the live trading room, and this was all done before lunchtime. And students who earn while they learn, let me go back to this for you real quick. Who can earn while they learn. They're doing 2 contracts. Some are doing 2 contracts. One did 181 ticks. The other did 500 ticks. That's $5,000 in 2 contracts. And the beautiful thing about this is you're going to notice that we will take each trade as a standalone. In other words, we never dollar cost average into a winner or a loser. Everything is a standoff, a one-off trade. And we measure it first upon risk. Risk first. So until I get down to 1145 or back up through here 1157, I have nothing to do in the Russell right now. Let's take a look at the S&P. We're consolidating around this high volume at 1958. So we're trading off of this level. Odds are we're just going to come right back into 1957 for right now, overnight. Then when we open, depending on where we open, we're either going to open within value area. If we open within value area, the rule was stay away, right? If you open outside the value area, so as it's coming in now, you want to look to position yourself to get long into the value area. Because it's spent now, since 1130, it's spent most of its time at 1957.50. That's its median, that's its range. And this looks like basically a standard deviation curve. So if you get a standard deviation away to the top side or standard deviation away from the bottom side, you can look for a reversion to the mean trade. And you will be doing the same thing that institutions do to better their trades. For some reason, I can't get my website back up. Maybe this will work. No, for some reason. Let me just bring up a new. Okay, so as I mentioned, I'm part of Global Trade Room, and we're a group of traders, and we have traders among us who are ex-pit traders, ex-NASDAQ market makers, ex-institutional traders such as myself, mathematicians, guys who programmers. We are an elite trading group, and we share this knowledge in order to build a proprietary trading group that will be funded and backed by an investor. That's our main goal. So you may be asking, well, why is this guy sharing all this information? Well, there is an end result, and there's an opportunity because we have a method that professional firms come to us for and ask them to train their traders on our risk management skills, because again, risk management is number one at any level. We show how to manage risk, period. We identify risk and then we put on trades. And there's a specific way to do this consistently every single day as a business. So here's a snapshot over the last 7 week total, over 3,000 ticks. This is just in the morning sessions, averaging 96 ticks a day. This week alone, we've done, we did a day of 231 ticks, and today 200 ticks. And of course, some traders doing a little less, some traders doing a little more, and those are students. So click on here, join us. We're going to open this up for the very first time only. This is summer, you know. We're going to start with the London session at 4 a.m. Remember, Sandy was with JP Morgan, Citibank, Merrill Lynch, Santander. We're going to go with the CTA day 2 and day 3 as well. Okay? Any questions? No. If you are non-resident, non-U.S. resident, for right now, you guys, I apologize, but okay, that's a very good question. Great question, Rolly. How do I do it? How do I know whether the market's going to go through a breakout or just a head fake? Oh, excellent. Very, very good question. 4 a.m. Eastern Standard Time, yes. So if you go into this and you click here and you register, just register for this one. We'll send you the rest for Tuesday and Wednesday. I know it's unfortunate, you guys, but here's a little side note. The parent company has been doing this for a long time in Europe, so they can accept European. The North American derivatives exchange is a new exchange, and we hope that this will be a good exchange for us in the future. But let me get to that very important question, and that's what I rely upon order flow with. Rolly, I rely upon order flow to tell me whether we're buying or selling. How much time do I have? Is there anybody still in the room, by the way? Okay. I don't have the particulars on that, J-Dub. but I would not start with an IRA account. I would start with, there's a free trial at nadix.com, and you can open an account for $100, and you can put on a contract and just wait for the market to come into your area. And instead of taking something that's got $50 risk, take it when it has $20 risk. But again, important and very important is to understand these value areas. Now, how do you find the imbalance, the head fake? Okay, good question. I'm not going to give, now this part I'm not going to give away, by the way. This part is, this took a lot of time reading the tape, understanding how the markets work, and I'm just not going to give this part away. But what I will tell you is you can see in these numbers, the bid and the ask, you can see the trade imbalances occur, and when they occur at levels, at your particular levels, your homework levels as I call them. For instance, this is gold. Let's take a look. I have a 25,000 volume chart on gold. So I have here, you see these red lines that are coming out from 1340? Those are filtered trade sizes of larger contracts, and it's drawing out these overlapping block sellers. So these block sellers are providing what's called a lid at 1340. So if as I come up to 1340, which I happen to have this yellow line, which is basically a piece of homework, it's a homework level, let me just adjust it a tad. As I'm coming up to that level, there's a few things I can do. I can look at the order flow, and I can look to see if they're getting aggressive or not coming into this area. If they're not getting aggressive, then I can believe that all the buyers that were down here and continued through here are no longer participating up here, and they're losing interest. So they're not willing to pay the higher prices. And or the other side of the trade, the sellers that are here, that came from 945 and also on the 10th, 710, and overlapping, there's a large trader in here selling gold. And he hits it, and he hits it, and he hits it, and he hits it. So he can also be absorbing the buyers, and how it will show up on the tape is they will become less aggressive. And then I can look for an opportunity to short from there. If I get back into, let me show you a couple trades that I did today. I might have to show you on a regular chart. Wait, nope, not that one. Not that one. Where are my markings? Okay, well, where do we know? Okay. Where's my Russell short-term chart? Okay, I have it. Okay, so here's trades from today. So what I would do, I'd see these yellow lines, 1162.7, 1163.8. Those are reference points for me that I did homework-wise. So I took a look at a longer-term time frame, and I found an area of buyers and sellers, and I drew those out. So that's an area I wish to do business at. There's also this red dotted line. This happens to be the value area low of some previous day. So remember that 68 to 70%? I have this extended out to show me the value area low that came from some period. It doesn't really matter. Here's a value area low of some other period. Here's a value area high of some other period. These just become reference points. And in each one of these, what I'm going to look for is the buyers and sellers to accumulate, and then I'm going to see, what did I mention that it takes to come out of balance? So I marked this up. Actually, this was live in our afternoon session, by the way. So I marked this up as this is obviously markets going back and forth, back and forth, back and forth, right? And in order to come outside of value, what needs to happen? What needs to happen? An imbalance needs to happen in that there has to be someone willing to sell 200, 300, 400, 2, 3, 4, 5 to 1 over the buyer. And so I can see that within, if I look inside the numbers as they're happening through one of these bid-ask charts, that it'll tell me whether I need to be going short or long. So I'm simply riding the coattails of the institutions. I'm not fighting them. Don't fight them. Just understand them. Understand your competition and understand where we can excel as retail traders. We have a lot of benefits these days, by the way. Even if you've been trying to trade for a long time and just haven't gotten there yet to consistent profitability, keep at it, because the markets are really transparent and the technology these days are amazing. I created this program myself to help me identify different levels, trade levels that I want to see happen and I want to take trades at. Unfinished auction levels, so unfinished business. Guys, I'm sorry. I do this every day, all day, and obviously I could go on forever. But did I answer the question, Rolly, about you need a big seller, and I just want to identify them? And I don't want to, honestly, I don't want to wait until an indicator tells me that there's a seller. In other words, I don't want to wait for a Williams percent to be above 70%, or an RSI to be above 70%, or below 30%, or some oscillator that's going to get me in after the bulk of the move is done. I want to see when it happens, exactly when it happens, to the tick, and I can see that when I look at the numbers, and I understand the markets, and I simply just sit there and wait for my levels. Hey Maverick, what's up? How are you? That's pretty much all I have. Join us for the next 3 days. I'm sure they'll come up with an offer to get you to join us. All you need is the right method, the right mentor,
Testing.
and the right mindset in trading. And we focus on all three of those very, very important components. Okay? That's pretty much all I have, you guys.